Hello and welcome to part 1 of the order block strategy. Now, before we get anywhere, what I suggest is to make sure that you do not miss any of the videos in this section before jumping on to either a demo or a live account. Even if you do finish this section and all the sections for the order block strategy, I don't recommend jumping into a live account until you feel you are confident enough and producing profitable trades either on backtesting or forward testing on a demo account until I don't suggest that you jump to a live account until you have successfully been able to produce that. What I suggest doing is once you've finished and I remind you at the end of this strategy, is doing the 100 trade test, which I know sounds long, but it helps you build your confidence in order to succeed using this strategy. This strategy is by no means easy, and what I suggest is making sure you're taking notes throughout the videos, and I've made the videos as short as possible to make them into bite-sized chunks. So without further ado, I will start off with the very first video. Now the first video is identifying an order block. Now before you get anywhere with this strategy, you need to know the reason why. Why are we trading the way that we are? So essentially, we know that institutions are the reason why these big moves are happening, right? Retail traders do not, we don't do any of this. We don't produce big impulses like this, okay? That's all for the institutions. So what does that mean and how does that benefit us? So essentially what we are doing with this strategy is we are trading the footprints that are being left behind by the institutions. So what do I mean by that? So have you ever been in a trade where you're like this? So you're going in, you're in a nice uptrend, right? And you got a nice, sorry, let me actually move that there. You're in a nice uptrend, right? And you got a great trend line, and also I'll use this, and also you've got a very nice EMA. So have you ever been in a situation where you're in this situation, you got a one touch, okay, that's probably 3 touches actually. Let me get rid of this one here. Okay. Have you ever been in a situation where you've got 1 touch, 2 touch on a trend line using a standard retail strategy, and then you place a trade going on the 3rd touch, right? But then this happens. You get probably sometimes a small reaction, right? And then price shoots down. And then what happens afterwards? Price decides to fly in the way that you were going to trade anyway. Now, you're probably thinking, that was just a stop hunt. And the thing about that is, yes, it was. Okay, these are real. What does that mean and how does that benefit us? So using a standard retail strategy, not saying that we are institutional traders by any means, we are still retail traders, so do not forget that. But we need to be aware of what is happening in this situation. Let me show you another example. Have you ever, let me draw this out, let me take this out of the way. Have you ever been in a situation where you've got this strong support level, okay, you look to enter a trade at this support level, then what happens? You get a small reaction, which is fine, and then you get taken out and then price continues. Okay, so we've got this strong support, right? There's a lot of support and resistance traders, and you're probably thinking, okay, I've just been taken out, my stop's been taken, but I got the direction correct. Okay, well done. But you still lost the trade. Alternatively, in this situation, have you ever been a breakout trader where you've been placing a trade at the breakout, you're expecting price to come, right? And then you catch the breakout and you're thinking, yay, you got it correct. But then you get taken out. All right, you were completely wrong on that trade. Why is that? Okay. That's what you need to think about. Why does that happen over and over again? These strategies are based on probabilities. However, it ignores what is actually happening in the market and who drives the market. When price is being pushed down and then goes up in your favor, what you realize is price does this. Why is that there? Price does this. It goes from here, it comes back down, and then it continues. Now, at this point, you're probably thinking, why does it do that? So, let's think about it from this perspective. So, everyone knows about support and resistance. Okay, everyone knows how that works. Even the institutions. So they know that people are going to be placing orders at this point. They're going to be placing buy limit orders to catch the bounce and sell stop orders to catch the breakout. But for the market to work, someone needs to lose and for someone to win, right? So for me to win, you need to lose. For you to win, I need to lose. Not directly, but that's just how it works. That's how the markets function. Okay, it's a sad truth. Institutions are fully aware of these standard support and resistance strategies, these standard trend line and FIB strategies. Sometimes they work, sometimes they don't. But this is the reason why. Because they're based on probabilities and it does not actually think about what is actually happening in the market. Price, right? If we do this as... No, actually, let me just change the color. Oops. There we go. So price is being pushed down. Right. And then what happens is... Let me use a green candle. Okay, so green is my bullish candle in this situation. Okay. Right. And then what happens is price comes and it comes back down. And then it shoots back up again. Oh. There we go. Okay, and so on. Now, this push down before the push up is the first footprint. So price is being pushed purposely, right, by the institutions to take everyone out, to grab the stop losses and to trigger the breakout traders. Once they've done that, once they've grabbed enough liquidity, now it's time to grab liquidity from the breakout traders and price is being pushed up. Okay, but they wanted to go long. They've always wanted to go long, right? So they are going long from down here, right? Why is that not working? All right, so they're going long from this position, right? Which is fine. But if you think about it from this perspective, they've had to push price down to get there. So they've had to place a sell position to come down, but they don't use stop losses. This doesn't exist. So they are sitting in drawdown once price is up there. Although they're in a profitable trade going up, they're still sitting on drawdown on the first trade. They sacrificed this position to get a price there, to grab liquidity and create this move. So what happens is they need to close this sell position, right, to continue their move up. They don't want to take a loss. So they need to mitigate their orders, mitigate their loss in order to do so. So this comes into question, what is an order block? The order block is basically the last place where the institutions have placed their orders before the move happens. So if we think about it from this perspective, where is that position? Because what we can see is, I did not mean to draw that there, but what we can see is this is the last bearish candle before the bullish move. Okay, so what does that mean? This is the order block. This is the last place where the institution sold before price was pushed up. So they need to come and mitigate their loss, right? They need to close it either at break even or a small loss, and then they can continue their move as they always wanted to do. So they've always wanted to go bullish, right? But they need to close out this trade. This happens time and time again. So what does that mean? How does that benefit us? Is we know that this mitigation needs to happen. So we're going to look to enter at this mitigation because we know that price is coming back, and we're basically looking to take a trade from there to continue the move with them. Okay, not saying that we're institutional traders by any means. We're just following the footprints that's being left behind. Okay, so think about it that way. We are essentially trying to find the last orders that price can, the last orders where institutions have placed against the original move, against the move that they wanted to take. So that if they wanted to go bullish, we're going to be looking for the last bearish candle before the bullish move that broke structure. That's the next key point. So for an order block to be an order block, right? An order block needs to break structure. This is what we call a BOS. Okay, BOS is break of structure. So what we can see is the order block has broken this structure here. Okay, so we know that this is strong enough to do so. Retail traders will not create a move that will break structure, so just bear that in mind. The order block, as we know, is here. So for a bullish move, the order block is the last bearish candle before the bullish move. Okay, and for a bearish move, the order block is the last bullish candle before the bearish move. Okay, and this should just make sense. Why? It's because it's the last place where the banks, for a bearish move, it's going to be the last place where the banks have bought before the big sell happened. Okay, that's essentially all it is, and that's how we would identify order blocks. Okay, so that is a theory, we're all behind it. We are trading the mitigation of their orders. So if you think about it from this perspective, let me try find a good example. Actually, we were on a good example. Okay, when we talk about liquidity, it will make more sense. But what we know is when there is a price that breaks structure, and then it, for example, continues to go in the favor of the overall trend, that is questionable. Okay, because what we can see is that price broke this low that was being created, right? Because it created a low and it created a lower high, right? A lower high, and then it broke structure, created a new low, and then price went on to break structure. Why has it done that? It has grabbed liquidity from this previous low, right? There's also going to be smart money traders who's going to be placing a sell from this position here, from this order block, because that's the order block that broke structure. But the overall move, that as we know, the overall trend is bullish, and we'll discuss that later on in the course, which will make more sense. But price, the institutions have pushed this move. Okay, we know institutions were active. Look at these big impulses, right? Institutions were definitely active at that point, but then price impulsively broke structure. And if we look at it from a daily perspective, what we can see is price is breaking structure on the daily. Now, for that big impulse to happen, retail traders are not doing that. Okay, we cannot create those moves. Okay, now we need to identify where the order block actually is. So the order block is the last bearish candle before the bullish move, which we can see is here. Okay, we're going to talk about order block refinement in another section, but that's essentially how you find the order block. Now, we can question whether this order block here, we can question if that's an order block or not. And the answer is yes, that is an order block because it is the last bearish candle before the bullish move. But when we talk about refinement, it will make more sense why these are both equally valid in terms of being order blocks. Same situation as we have here, right? Same situation as we have here. So we have a bullish move which broke structure. Where is the last candle, the last bearish candle before the bullish move? Okay, we have one here. Is that an order block? No, because it didn't cause any break of structure, right? And if we look in the higher time frames, and this is where it makes sense, the overall order block is this candle here, okay? But it didn't cause any structure break. The structure broke from around here, okay? So yes, this is an order block overall. If we look at this from a different perspective, the order block that is sitting is right there, okay? It's either one of these two. But before the move actually happened is this one. That is your order block in this situation. And it will make more sense when we talk about refinement. But you need to understand what an order block actually is before moving forward. So to break it down very simply, an order block is the last place where institutions have been active before a move occurs. So for a bullish move, their order block is the last bearish candle before the bullish move. For a bearish move coming down, the order block is the last bullish candle before the bearish move, right? We are trading the mitigation of their orders. When price is coming back to the order block at the last possible place that they have placed sell orders, they need to mitigate those trades, and that's where we're going to look to enter. So this mitigation play, which is happening here, that's where we're going to look to enter the trades, okay? And that's essentially the footprint that we are trading. So in terms of order blocks, that's essentially all you need to actually understand. Okay, we are trading the footprints and we're trading the mitigation. So an order block needs to be strong enough to break structure, right? And it's the last candle of the opposite before the big move. That's all you need to think about. It's very, very simple, and we're going to talk about how to refine them in the next video.